In Chapter 2, we learned that indirect finance is much more important than direct finance. That is, in the financial market, most of the fund transactions go through the commercial banks, the financial intermediaries. In this chapter, we want to talk about the most important financial intermediaries. That is, the commercial bank. We want to learn how commercial banks work. What the commercial banks are doing is to do something called asset transformation. This is the balance sheets of the commercial banks in the United States in June 2014. For example, what they are doing is they issue liabilities. They sell liabilities to raise funds and then use the money to buy assets. This is called asset transformation. They issue liabilities to raise money and then use the money to buy the assets. Now let's see the details. First, let's see how commercial banks raise funds. That is, the sources of funds. The first part is the checking deposits. That is your checking account balance. You deposit your money into your checking account. That's your money. Therefore, that is your assets. And the commercial banks owe you this money. Therefore, it's their liability. So checkable deposit is commercial banks' liability. In 2014, it counts 11% of the sources of fund that they raise. What else? They also sell time deposit, that is CD, certified deposits, and savings account to you. The CD that the commercial banks sells to you is called the small denomination CD, time deposit. They also issue CDs to the business. Those are large denomination time deposits. These CDs and savings account are called the non-transaction deposits. They also borrow money. Borrow from whom? They can borrow from the fellow commercial banks. Where do they borrow money from the fellow commercial banks? They go to the federal fund market. Federal fund market to borrow reserves from the fellow commercial banks. They can also borrow from the Fed, the central bank. Where do commercial banks go to borrow money from the Fed? They go to the Fed discount window to borrow discount loan from the Fed. So those are what the commercial banks owe people. The last item is not what the commercial banks owe people. The last item is called bank capital. There are two things in the bank capital. The first one is called equity. That is, they issue ownerships to the shareholders. That's the stocks, right? So the shareholders own the commercial banks. The commercial banks do not owe people this money. But it's on the liability side because it is a source of funding. The second item in the bank capital is retained earnings. So this bank capital is actually the net worth that we have talked about before. When commercial banks earn money, that's their money. So you don't owe people money. You don't owe this return earning. That's the commercial bank's money. Therefore, it is inside the bank capital. Therefore, commercial banks borrow money and then issue equities and retain earnings. Those are the sources of fund of the commercial banks. One more thing. As you can see, almost half of the source of fundings are from issuing the time deposit and savings deposit. They are aggressively selling the deposit to the public to raise money. Then they use the money to buy assets. So on the asset side is the uses of fund. The first one is reserve and cash item. So this is the cash that they keep in their safe, and the cash they deposit into the Federal Reserve Bank. So reserve is actually the deposit of commercial banks in the central bank. Just like when you deposit your money into the commercial banks, your checking account balance is your assets, commercial banks' liability. Now, commercial banks deposit money into the central bank. So it is called reserve. The concept is exactly the same, just a different name. This part, your money deposit into the bank, is called deposit. Commercial banks' money deposit into the Fed, into the central bank, is called reserve. So reserve is commercial banks' assets. That's their money. But it is central bank's liability. What else do they use the money? They buy securities. Say, for example, U.S. Treasury bonds or bonds issued by U.S. government-sponsored agency like Freddie Mac, and Fannie Mae. They also buy municipal bonds and other securities in the market. They also make loans. Say, for example, they make commercial loans. If you want to open a restaurant, you go to the commercial banks to borrow commercial loans. Mortgage, consumer loan, your car loan. An interbank loan. What is interbank loan? That is, they make loans to the fellow commercial banks. So it is actually this term. They borrow money from the commercial banks, from the fellow commercial banks in the federal funds market. They also lend reserve to the fellow commercial banks in the federal funds market. So this is called interbank loans. And there are other type of loans, and they also use the money to buy computers, desk, the physical capital. This is called asset transformation. Now, it's not hard to see how a commercial bank can make money. They pay less to their liabilities and earn more on the assets. That's how they make money. Therefore, the commercial banks borrows shorter term, that is, issue shorter term liabilities and buy longer term assets, because short term securities have a lower interest rate, longer term assets have a higher interest rate. That's how they can make money. They also issue less risky liabilities so that they pay less interest rate. And they use the money to buy riskier assets so that they can earn a higher risk premium, higher return. That's exactly how commercial banks earn money. That's how they operate. If after you graduate from college and you are working for a bank, what kind of jobs will you do? Well, first, you can be a liquidity manager for the bank. Then you are in charge of this part of the bank balance sheets, that is reserve and cash item. That is exactly the liquidity of the bank. You can also work as an asset manager. Then your job is to be in charge of the left-hand side of the balance sheets, the asset side. You can also work as a liability manager. If you are a liability manager of a commercial bank, then you are in charge of the liability side of the balance sheets. You can also work as a capital adequacy manager. That is, you will be in charge of this part of the bank balance sheets. Finally, if you want to get a high salary in a commercial bank, then what you want to do is you want to be a risk manager in the bank. Then your salary will be very high. What your job is to manage the risk of the balance sheets, the whole balance sheets. Next, we are going to talk about these 5 managements, the principles of bank management, one by one. First, if you are a liquidity manager, you are in charge of the reserves and cash item. Note that cash and reserve item are the assets that do not earn any return for the bank. They're cash. Therefore, a commercial bank would like to keep fewer cash and reserves so that they can use the money to buy other assets like loans and securities. However, can they keep the reserve at zero? Use all the assets? Use all the money to buy the assets to earn interest? The answer is no, they cannot do that. Why? The reason is, look at the liability parts. Deposits. Deposits are from the customer. It's like your checking account. It is your money. It is the customer's money. You have all the right to come in to withdraw any amount of your deposit at any time, because that is your money. That is the customer's money. And when you come to the bank to withdraw your money from your checking account, the bank has to have cash to give it to you. Therefore, they will have to keep some money in their safe. cash in their safe. But do they have to keep all $90 of deposit in their safe? The answer is no, because not all the customers are coming to the bank to withdraw all their money out at the same time. Therefore, if you are the liquidity manager of the bank, your job is to estimate how much of this deposit will be withdrawn from the bank. That is, you have to estimate how much of this deposit that you have to keep in the safe, in the cash and reserve item. If the bank is very aggressive, then they will keep a small amount of cash and reserve in the safe or in the Federal Reserve Bank's account. If they are more conservative, then they will keep more cash and reserve. The Fed, that is, the central bank, that is, the boss of the commercial banks, that is, the regulator of the commercial banks, will set a minimum requirement, which is called required reserve ratio. Required reserve ratio. Say, for example, if the Fed sets a required reserve ratio of, for example, 10%, that means the commercial banks will have to keep at least 10% of the deposits in reserve. In this example, in this case, this commercial bank has a deposit of $90. Therefore, they have to keep at least $9 in the reserve. But the liquidity manager in this bank is way too aggressive. So by the end of the day, they ran out of cash. So by the end of the day, they will have to put $9 into the reserve to meet the required reserve requirements. The reserve requirements. But now they have zero. How can they get this $9 into reserve? The first solution and the most used solution is to borrow from the fellow commercial banks. Where do they go to borrow reserves, cash, from the fellow commercial banks? The answer is they go to the Federal Fund Market. They go to the Federal Fund Market to borrow federal fund. Federal fund is the reserve. They are the same thing. Reserve is the federal fund. What is reserve? The concept is easy. If you deposit your money into the bank, that is called the deposits. So deposit is the customer's assets and commercial bank's liability. When commercial banks deposit money into their bank, that is the central bank, then that money is called reserve. It's called reserve. So reserve and deposit have exactly the same concept. Consumers' deposit in the bank is called deposit. Commercial banks' deposit in the central bank is called reserve. So when this commercial bank is short of reserve, they can go to the federal funds market to borrow federal funds, to borrow reserve. Then what is the cost? What do they have to pay to borrow reserve? They pay the fellow commercial banks federal funds rate. So the cost of borrowing from the fellow commercial banks is called the federal funds rate. They have to pay federal funds rate because they borrow federal funds, that is reserve. Then in this case, they borrow $9. Liability increases by $9. Assets reserve increases by $9. Therefore, now they have $109 in assets, $109 in liabilities. The balance sheet is balanced. The second solution to this liquidity shortage problem is to sell securities. But what is the cost? The cost is if you have to sell your securities. If you have to sell something, you will have to sacrifice the selling price. Because you have to sell in the market, therefore you have to lower the price of the securities that you own in order to sell the security to get cash. Therefore, the second solution is to sell $9 of security, so you have $1 left, and then you will have $9 of reserve. In reality, this is the cost because you may have to sell actually $10 worth of securities in order to just get $9. Okay, we ignore the details here. Then on the asset side, you still have $100. Liability doesn't change because you don't borrow any more money. It is still $100. The balance sheet is balanced, but the cost is you may have to lower the price of your security in order to sell it. Okay, then you will have to have some loss here. The third solution for liquidity shortage is to borrow from the Fed. Where do you go to borrow from the Fed? The answer is you go to the Fed's discount window. To borrow discount loan. Then what is the cost? You pay discount rate. So the cost for borrowing from the Fed is to pay discount rate because the loan that you borrow from the Fed is called discount loan because you go to the Fed's discount window to borrow discount loan. In addition to that, the worst implied cost for borrowing from the Fed is the Fed is the commercial bank's boss. It is the regulator of the commercial banks. So if you go to your boss to borrow money, your boss knows that you are way too aggressive. Then your boss will keep an eye on you. Therefore, if commercial banks go to the Fed to borrow discount loan, they may be monitored by the central bank, the Fed. Therefore, this is the choice that the commercial banks do not want to choose. This is the stigma for going to the Fed to borrow reserve from the Fed. In this case, they go to the discount window to borrow $9, and their reserve increases by $9. On the asset side, you have 109. On the liability side, 109. Balance sheet is balanced. But this is the least case that the commercial banks are willing to use to increase their reserve. They don't want to go to the Fed to borrow discount loan. Finally, the fourth choice is to call in or sell off loans. What is the cost? Remember the mortgage example? When you try to apply for a mortgage, the bank is asking for everything from you. They want all your information. They spend a lot of money, a lot of effort to analyze your credits, and finally makes the decision to make you a loan. When they get your credits, they know your credits, they know your personal information, then they want to keep this private information. So they want to continue to be good to do business with you, because that is the private information that they spend a lot of money and effort to get. But now, if the bank just call you and say, sorry, we want to call back your loan. You have to pay off your mortgage now. Are you happy? No, you are not happy. Therefore, this solution, what is the cost of this solution? It ruins the customer relationship. They ruin the relationship that they spend a lot of money and effort to build. Therefore, this is not a good solution. However, this is one of the solutions. In this example, loan decreases by $9 and reserve increases by $9. You still have $100 of assets. Liability doesn't change. The balance sheet is balanced. The second type of job that you may get in a bank is to be an asset manager. If you are an asset manager, then you are in charge of the left-hand side of the balance sheets. So your job is to buy assets. All right, if you are an asset manager, what is your role in the financial market? Are you a borrower or a lender? The answer is you are a lender, because you are using the money to buy assets. You're buying a piece of paper and give the money to people. So you're buying the assets by paying money. Therefore, you are lending out your money to get that piece of paper like CDs. Okay? Therefore, if you are an asset manager for a bank, you are a lender. Therefore, you are on the lender side of the financial market. So you are on the bad side of the asymmetric information problem. You got less information because you are a lender. You don't know what borrowers are going to do, and the borrowers are using your money to do things that you don't know what they are going to do with your money. Therefore, you are on the bad side of the asymmetric information problem. Therefore, your job is to manage credit risk. You have to solve the asymmetric information problem because you are the victim of the asymmetric information problem. So we spend the whole chapter 8 to talk about how to solve a symmetric information problem, and you are the one to solve this problem if you are an asset manager. In addition, don't forget that on the asset side, the first item is reserve and cash item. Reserve and cash item, that is the liquidity part of the bank assets. Therefore, you will have to work with your liquidity manager to keep adequate liquidity so that you can use the maximum amount of money to buy assets to earn money for the bank. The third type of job that you may get to work in a bank is to be a liquidity manager. Now, as a liquidity manager, what is your role in the financial market? Are you a borrower or a lender? The answer is you are a borrower, because you are issue liabilities, a piece of paper, and people give you money. Therefore, you are a borrower. So you are on the good side of the asymmetric information problem. Before 1960s, banks used to serve a role as providing the banking service to the customers, to the public. So before 1960s, banks usually just open their door and accept deposits from the customers and then use the deposit money to buy assets. So the majority of the liability of the commercial banks before 1960s was check their deposits. So the banking before that time was simple. However, after all those financial innovations after 1960s, banks become very aggressive in earning money. That is called the money-centered banks. They figure out that they have a lot of investment opportunities. So when they see good investment opportunities, high-paying, high-return assets, then they become more aggressive. They go out and issue CDs or go out and borrow monies and give the money to the asset manager to buy those higher return assets. Therefore, after the 1960s, liquidity management becomes very important because this is the source of funding for the commercial banks. The expansion of overnight loan market. They even borrow overnight. They issue overnight or negotiable CDs, new financial instruments, all those financial innovations. They borrow overnight to buy overnight assets. They're so aggressive. This is how the commercial banks are running right now. Therefore, liquidity management becomes very important after the 1960s, after all those financial innovations.